Moving on, current liabilities. In current liabilities, you have accounts payable. So how do you forecast it? You forecast it based on payable days. So again, balance sheet notes, accounts payable. What do you pay for? You pay for supplies. What are the supplies? Supplies are in the form of purchases. And where are purchases used? Either they would turn into stock or they will become a part of cost of goods sold. So if I have to calculate purchases, how do I calculate purchases? Purchases are simply opening stock plus cost of goods sold minus closing stock, right? So if you have purchased something, either that would become a part of stock or that would become that would be used, that would be bought and sold. So what do? You take closing stock minus opening stock. Closing stock minus opening stock would tell you change in stock. So some of the purchases would be used in as change in stock, and then you take cost of goods sold. Some of the purchases will be used as cost of goods sold. So if you combine these two, it will become your total amount of purchases. How? So if you have purchased something, made some purchases, either you will sell that product, which means cost of goods changed into cost of goods sold, or you will add it to stock. Adding it to stock means your total stock will increase or decrease. And how do you find out increase or decrease in stock? It is closing stock minus opening stock. So if I take closing minus opening and add it to cost of goods sold, it will give me purchases. So in order to calculate purchases, I take opening stock from balance sheet, already forecasted. I take COGS from balance sheet, already forecasted. COGS from income statement, already forecasted. Closing stock, again from balance sheet, already forecasted. Purchases would be closing minus opening plus COGS. This will forecast purchases. I have purchases. Based on purchases, I can forecast creditor days. What is the formula? Simply your purchases divided by account payable multiplied by 365. So this will tell me the days for 2016. And then I can either take average of past 2 years or I can take recent days as it is and forecast the future. So this will tell me forecasted future days. Once I have forecasted future days, I can use these days and the purchases numbers to estimate or forecast the account payable. So account payable will simply be days divided by 365 multiplied by purchases. Any problem so far? So this is how you forecast accounts payable.